My name is Brett Corrigan. I've been a professional trader for about 6 years, and today I'm going to show you guys how I went from negative P&L year to date, losing money every single day, to now having multiple six-figure years back to back to back in a row. How I went from that to where I am today, talking specifically about my exit, my profit-taking strategy, my profit-taking approach. As you guys are going to learn, trading is three components. It's your entry, it's your stop loss, and it's your take profit. Now, if you find out that your stop loss is too wide, then it's kind of like having a hole in your boat and water is always coming in. That's one of the biggest problems you have as a trader. Now, usually traders get that figured out first. The second problem is going to be your entry system, and your entry system is a whole other topic. And your third problem, which is probably one of the most important problems, is going to be your profit-taking strategy. And going back to that same analogy, it's kind of like having a hole in your sail. If you don't have a proper technique to taking profit, you're not going to let your runners go as far as they should, and therefore you're never going to see big trades. The goal with profit taking is to essentially maximize the amount of value you're getting from that trade and reduce your risk throughout that whole process. And that brings forward the idea of a trail stop technique. So before we even get into our trail stop technique, I want to talk to you guys specifically about why traditional profit taking approaches are not effective in the long run. The reason why is because there is an inherent randomness to the market that you have to understand and respect as a trader. If you are a trader who trades off of a level-based system, which I assume most of you guys do, or you have some other approach that probably follows some degree of levels, your basic assumption is that if a stock breaks resistance level 1, it breaks R1, it's going to go to R2. Now that's obviously a very good assumption, and that's what we all learn, and I also agree with you, it should in theory go there, but that's all in theory. In practice, it could be very different. What if, for example, you were to buy 100 call contracts, betting the stock would go up in value from 585 to 589? This is your profit target. And what if you got in calls right here at this precise moment? The stock rallies higher, and then rejects 20 or 30 cents off of your level. You don't take any profit, and it goes all the way back down to your stop loss, and it stops you out. You would be very mad, of course. Why? Obviously because the stock moved in your favor, almost hit your profit target, but then rejected off of early, and then obviously resulted in you stopping out of the trade. Now, this is going to happen very often, but how do you actually protect yourself? But what if I were to tell you this happened? What if I were to tell you you got in calls right over here, you waited for your full profit target here at 589, you sold your full profit target at 589, and the stock rallied all the way to 595 plus. Now you're going to look back at this chart and say, well, damn, I should have held this position. And you're sitting there in hindsight, probably a little bit upset, wondering what you could have done better to hold this trade. And that brings forward the idea that the market is simply random. Stop trying to assume you know exactly where the stock is going to go. Your only assumption as a trader should be, I know where my entry is, and I know where my stop loss is. That's all you know. You have a basic idea of where you think the stock could go, right? It probably has room for the next level of resistance, but you don't exactly know what's going to happen. You don't know if this trade is going to be a 5% trade where it just moves a little bit higher than rejects. You don't know if it's going to be a 500% trade where it goes all the way sky high. Once you understand and respect that as a trader, you now can trade much more effectively, not based upon emotions, not based on profit targets, but instead based upon some sort of trailing stop technique, which is what I'm going to talk to you guys about today. So now let's talk about trail stops. So what is a trail stop? A trail stop is the idea of basically having a dynamic stop loss that's going to move up with you as the trade works in your favor. So if you're in puts, it's going to move down with you as it's working in your favor. If you're in calls, it's going to move up with you as it's working in your favor. Now, why does this exactly work, and what does this do for you? So the first thing is it's going to basically reduce your risk by allowing you to move your stop loss to your precise break-even point as a trade works in your favor. The second thing it's going to allow you to do is it's going to allow you to move your target freely without a fixed profit target. Because you understand that the market is simply random and you don't know if you're going to get a 1% move or a 20% move, this is going to allow you to freely adjust your position and take bulk position off, but basically unlock your profit target to reach its full maximum potential, which in theory could be infinite. Obviously, it's not going to be infinite because you are going to take profit at a certain area, but it is basically going to increase your reward vastly. Why? Because you're not waiting for a precise number, you're waiting for it to essentially break trend or break structure. Now, we're going to talk about that in a second. So let's go back to our example here on the S&P. So if you were using the traditional profit target approach, you would get in calls over here and you would take profit here. Maybe you get in calls over here, you take profit there. But in theory, this won't work in the long run. In practice, obviously, you know that this is very difficult to do. So what can you exactly do here? What you're going to do is you're going to get in your position here, same point, right? That's not changing. Your stop loss is going to be the same point initially. That's not changing either. And your profit target is also going to be the same thing. That's your profit target. It's your idealized profit target. But what you're going to do is when you get your first impulse move in your favor, that is the precise first area to take profit. So for example, this could be a new high of day. This could be a large equity move in your favor. It could be essentially a big impulse or large volatility candle in your direction. And for me, that is enough to start taking off a little bit of profit. And the issue with this, and here's the counter to this approach, because now I talked about the positives, let's talk about the negatives here. The negatives here, you're taking some of your position off before it even gets to relatively close to your profit target. Now, if your risk reward was this, let's just say your risk was this much and your reward was this much at first, well, if you now start taking profit into the first impulse candle right there, well, your risk reward is no longer simply this and this. It's now this. It's this and this, right? So a general rule of thumb is I will never be taking profit, even with the trail stop technique, until I at least meet my risk. So if my risk is $1, I need to see at least $1 on the underlying stock to get my first trim. So while I do look for an impulse move, I also look for an impulse move that is equal to or greater than my risk. So again, if my risk is $1, I want to see at least $1 on that impulse move to start taking profit into. Now, the second reason why I take profit is, again, if it pushes my price size level. So that's another reason to take profit, is if it pushes into your exact level or your idealized profit target. I simply will take profit there, because sometimes you might get a massive green candle right into your level. That is a reason to take profit. And the third reason to take profit is if it breaks structure. So let's talk about that. So for example, if I'm in calls here, right, off of a move higher into 587 and I take my first trim, let's just say I'm in 100 contracts, I take about 25 contracts off or 30 contracts off. What I want to see now is I want to see structure hold. And in order for me to see structure hold, what I'm going to do is I'm going to essentially raise my stop loss up as it continues to move in my favor. So for example, my stop loss was here at first. If I'm taking my first trim here, I'm now going to take my new stop loss, my old stop loss, and move it to my new entry point, my entry point, which is 585, and that's my new stop loss. So in theory, I now no longer can lose in this trade. So if this stock pulls back here and breaks under 585, I can't lose money in this anymore because I stop out right there at my break-even point and I walk away for a small gain. And my reward, so my risk is zero, my reward is potentially infinite because my reward can go all the way up to the next few TPs and beyond. So in theory, by using a trail stop technique, I am doing this. I am lowering my risk reward initially. Yes, it's true. My risk reward is fundamentally changed negatively by doing a trail stop technique because I'm trailing out early. But what I'm also doing is I am also protecting my profit. I'm protecting my profit. I'm protecting my gains. I'm protecting my wallet. And I am increasing my potential reward if it does continue trending in my favor. Because again, I can potentially see a move beyond 589 if the stock continues to hold structure. So while I am initially giving up some of my reward by taking early trims into the first impulse move, I am also increasing my reward by targeting a move beyond my intended profit target by using a structure technique. The structure technique that I use is simply just raising it to the previous 5-minute candle low. Now you could do something different, right? You could use it if you're trading on the hourly time frame. You could use the same idea here, using the hourly candle low, same as the 5-minute, but just doing the hourly, or even the daily candle low, right? But the idea is simply the same. You're just going off of the previous structural level, right? Which again could be the candle low of the 5-minute, the hourly, or the daily. The other approach is going to be actually an EMA approach. So the EMA approach is pretty simple. All you're going to do is go over to your indicators tab and you're going to add a basic indicator called an EMA or an exponential moving average. Essentially what this is going to do is it's going to basically allow you to preset your stop loss to this level. So for example, if I remove my clouds over here, we'll put in the 9 EMA. In this case, we're actually going to adjust that to the 8 EMA, right? The 8 EMA. And this is our stop loss. So we get in our calls over here. Our initial stop loss is here at 584.40. As the stock moves in our favor, we get the big impulse move up. We're going to take our stop loss and now not use structure, but use structure in the form of not a candlestick, but in this case, a EMA. So again, structure could either be off a candlestick low, or it could even just be an EMA, whatever you want to call it. Now in this case, our EMA is our stop loss, so we're going to hold this position as long as we are above that 8 EMA. And if we crack below that 8 EMA, we then get out of our position in profit as the stock is already moving with us, because this is a trend-based indicator. So the idea in this case is you essentially are going to be taking profit into impulse moves up, taking profit into your first risk, meaning if you're risking $1, taking profit into your first dollar you see, and then using some sort of trail stop technique, which again could either be the candle low technique off of structure, or it could be an EMA approach, which again is a form of structure. This is all we're doing as a trader. And the question is this is the question I pose to you guys, is how much do you sell, right? So if I'm telling you guys that we take profit into our first impulse move up, how much do you sell? If you have 100 contracts, does that mean you sell 50? Does that mean you sell 80? Does that mean you sell 90? To answer that question would be simply going into your own mindset, right? What's your mindset going into the trade? Are you aggressive? If you're aggressive, then hold for longer, right? Maybe sell only a small position off the get-go and then hold majority for the bigger move up. Or if you're more conservative, maybe take majority of your position off into that big move up initially and only hold a small position as your trail stop. So there really is no right or wrong answer to how many contracts you're selling or how many contracts you're holding. The right answer, though, the real right or wrong answer is, do you have a trail stop technique? If you don't, I would recommend looking into one. Anyway, this is my YouTube video. I hope you guys learned something from this. I know not the most exciting of videos, but this is my first really informative, deep video that I hope maybe provides some value.